but we'll see how I do. Um, so this morning we're going to take a look as we did last year at the coming year and offer up some prognostications and some essentially some milestones. We want to talk a little bit about where the market has been, where it is, and maybe make a few predictions about where it's going. But that's always a dangerous thing. I mean, if you think golf is a humbling game, I think economic forecasts and market calls are probably an even more humbling experience when you go back and review them. But we're calling this borrowed time. I think there's a sense, that the market pundits and participants, the various seminars that we participate in, the talks that we give as a group here over the last year, that this market is maybe living on some borrowed time, that the valuations, we're going to talk specifically about valuations here in a little bit, but certainly the last great financial crisis is 10 years now in the rearview mirror. So 10 years afterward, the market looks very different than it did in 2008. So the first thing we're going to do here is take a kind of a report card, if you will, and kind of review what we said last year. And we spent a lot of time last year, I think, talking about Europe and a little bit about China. So we're going to revisit those. And then we're going to talk a little bit about how the investment landscape has been changing, what's different now versus a few years ago, and why it's changing. Talk a little bit about Bitcoin, which is all the craze. And it's certainly been talk about whether or not that's a bubble, and in fact, that even a lot of people, I think, don't even have an idea what Bitcoin actually is. So we're going to talk a little bit about that, and finally a little bit about the monetary policy. I think we're going to leave that off, and finally come back with a summary. So the expectations and predictions from last year in the Trump administration, we put out as part of the presentation last year, the big winners and losers in the first month or so of the new Trump administration. We were literally just a few weeks into the presidency, and the president-elect at the time had been known for only a couple of months. But we certainly saw that, in the materials, the financials, industrials, healthcare, tech, information and technology, the weight on the index for tech and information technology is about a quarter of the index now, and we said that was a winner. I'm not sure we're labeling that incorrect. Perhaps we weren't expecting it to be as much of a winner as it was. But certainly the biggest winners in the index that we were pointing out a year ago continued throughout the year to be the kind of the leading sectors. We had rotated from defensive to more growth-oriented industries. For instance, utilities had been a winner in 2016, and we expected to lag a little bit. It did, in fact, lag, but a 12% return is still pretty good. Telecom and telecom services was one of the worst performing sectors last year, and that was something that we kind of expected as well. Energy is still was still at the time mired in $30-40 a barrel oil. We're up to $64 a barrel today. Energy is, in fact, starting to come back, but it's still not, not at the levels. The energy stocks, there's a lot of makeup that they need to do in that business. There are a lot of very poor balance sheet, good businesses, but have very poor balance sheets, very leveraged balance sheets. They took on a lot of obligations at the top of the market when oil was still 100. We're back to 64, but there's still a lot of work that the energy business has to do to get its ship righted, if you will, particularly in terms of balance sheet repair. So all in all, I mean, it looks like what was happening in the markets pretty much would continue the trend for 2017. 2018, I think, might be very different. We talked a little bit about the stability of Europe moving forward here, and the so-called Italy, which, you'll probably all recall the Brexit vote in England, that the UK decided to leave the European Union, the EC cooperation bloc, and go it on their own. The UK still has its own currency. It still has the pound sterling as the currency. They don't use really the euro in England, although they can. But one of the more interesting developments at the end of the last year was Marine Le Pen was one of the leading candidates, although she was not expected to win the French elections. She did not. Macron won the prime ministership in France. And interestingly enough, he has recently said that if a vote were held today, that France would probably leave the EU too. That kind of took the European pundit class and press by surprise for him to actually admit that. But it may or may not be true, but it is certainly, France is leaning that way now. Italy had been leaning that way. That there was a movement called the Five Star Movement, or M5S. It's a political party that's developed in Italy. It is still something that is going on there. We talk about it as a possibility, but not necessarily the highest possibility or highest probability outcome. It is getting higher still. The new elections have been called in Italy for March. They dissolved the government here at the end of 2017, and in the M5S, the so-called Five Star Movement, which is a populist movement that wants to break out of it's anti-establishment. It wants to break out of the EU establishment into the EU kind of bureaucracy, if you will. They have no love for the European bureaucracy, and they are actually the leading party in the polls now in Italy, and for that matter, in a good part of Europe. Coalition governments are kind of the norm. That there's not two necessary leading parties the way there are here in the U.S. There are multiple parties that form coalitions after each government election. And even though they're leading in the polls, they have less than 30% of the vote. They've got about 25, 26% of the vote in the most recent polls. So even though they're the leading party, they still don't have enough necessarily followers or alliances, if you will, to be the one to form the actual government once the elections come in, at least not according to the press and the polls there now. Why this is important is that if you look at banking data, GDP, IMF data, Italy still has some of the highest percentage of non-performing loans in their banking system. Why is that important? Well, non-performing loans, bad debts within a banking system, or within or God forbid, in a government sovereign, if the government fails in its debts, is very, very deflationary. It's an extremely disruptive event for banks to default in mass. That's why we had TARP in such a massive scramble in 2007, 2008 in this country, as in other countries. A teetering banking system and an insolvent banking system is very problematic. The growth in GDP in Italy since 1999 has averaged less than half of 1%, and yet their debt stands at 133% of their GDP. So basically, you have this mix in Italy that looks very much like Greece did a few years ago, where you have a very slow economy, you have a very weak banking system that's rife with non-performing loans, and several bailouts have occurred, including Banca de Monte Paschi, I believe is how they say it, which is one of the oldest continuously operating banks in the world. Its opening predates the discovery of the New World by Columbus in the 1400s. That bank has been around since then, and it had to be bailed out last year. Just kind of an indication of how far that banking system has gone. Very high debt, 130% of GDP. That is giving rise to M5S, which is political populism. When you have this kind of thing, it tends to cause a great deal of unrest and anti-establishment type of sentiment, and that could be a political earthquake. That would be a major deal, because if Italy leaves, France is, even the president of France is admitting that that his country may want to leave the EU as well. There may be a brewing problem there. The bond markets are aware of this, but they seem to be rather complacent. As we see here, this is 10-year bond yields versus the benchmark kind of German bond yield. So within the Eurozone, Germany is kind of the gold standard, if you will, of government finances. And this is the difference, the spread in basis points between the Italian yield, which is probably the worst of Europe, and the German yield, which is the best of Europe. And you can see that it dropped and dropped through 2014 and 2015, and then about 2 years ago, it started to rise again. So the premium to buy Italian bonds, you needed to offer a premium in Italy over the German bonds. But that starting in 2017, about the end of first quarter or so, it's been just slowly but surely coming down. It's still very wide, and probably wider than the average today, but not by much. It's there's definitely a complacency about this, even though these elections are coming up, and even though this populism is rising in Italy. When major players start leaving the Eurozone that are part of the European currency, that use the euro as currency, it's not as disruptive for Britain to leave, for a UK to leave, because they have their own currency. They still have a chance for the exchequer, which is very independent. But when member states that are sharing the currency leave, that is a big deal in Europe. And we see that as one of the potential, probably the major fault zone in international banking and finance, is this probability that there could be a breakup or restructuring, if you will, of the euro. So China was the other big story that we talked about last year, and that continues to be more of the same. This is you can see the estimated GDP growth in China, which is this white line, and it's on the right scale, and it's been running a little over 6%. And there is some doubt about that because I believe it was the province of, if I'm saying it right, Liaoning province last year was found to have fudged the numbers a little bit, and by a little bit they overstated it. They overstated the state GDP by a factor of about 100%. They doubled it. And when there was an audit and people were held accountable for this, that it turned out that the actual number was half of what the state government officials said it was in terms of growth. And in China, everything rolls up from the state and local levels. So there's a lot of, just by the way they calculate their statistics and the way the political system works, there's a lot of fudging that goes on. So even though the stated number is 6.8%, we think that it might be closer to 6, but no one really knows for sure. What we do know for sure is that the debt to GDP ratio, which is in gold, this is all debts in 2008, 2009, about the time the crisis ended in the U.S. or was at its peak, the debt ratio in China started to climb and has been climbing ever since. So the debts in China, the amount of borrowed money that's being created in China is very high and continues to get higher even as GDP has slowed. That tends to be problematic, and you can see here now, starting in 2016, all the way through 2017 and into today, that in fact the yields have been rising. It's taking a higher and higher yield in China now to attract capital to fund that debt. So we're still concerned that Chinese debt, and particularly bad debts in parts of China, particularly related to real estate in their banking system. China has issues in its banking system with bad debt, and particularly speculative real estate, much the way we had here 10 years ago. They seem to be going through that now. The question is how the government will deal with it. So that would be probably the two. We continue to believe those are the two probably leading risks to the world economy or to major disruptions in terms of the prices of oil and commodities, in terms of world growth, in terms of world demand. So moving on now, let's talk a little bit about the capital markets, and particularly here in the U.S. and where we see some changes coming. So going back to 2014, the graph you see now here, we're looking at the total essentially cumulative equity flows in various types of funds. So there's exchange traded funds, and then there's traditional mutual funds. Exchange traded funds are a little different in the sense that they tend to be, because of the rules of allowing intraday trading within the fund, they tend to be more tax efficient for taxable investors. They also tend to reduce expenses a little bit because they're netting and crossing transactions in the fund all day long. So the other thing about exchange traded funds is that they tend to be more passively managed. That is, they tend to be tied to an index of some kind. So the passive index funds in the mutual fund business, you're seeing the people that would normally have bought a passive S&P 500 index mutual fund, for instance. It makes a little more sense for a taxable retail investor to buy an S&P 500 exchange traded fund, because they tend to get lower expenses at the retail level, and they tend to get more tax efficiency as well. And the popularity of these ETFs is rising. You can see here in the gold line, this is the ETF issuance. At the same time, the equity mutual funds, their net cash flows, that is fund flow in minus fund flow out, has actually been negative. So the stock market has still been attracting capital in the U.S., and through 2016 to 2014 it was flat. That's not surprising, because for most of 2014, 15, and the first few months of 2016, the equity markets were essentially offering very little, if any, return. The markets were sideways. They were kind of up and down, back and forth over the same trading range between, say, 1900 and 2100 on the S&P 500. So this period is also marked by very flat performance in the S&P. Now the election day is here at the middle, and at that point in time, after the Trump election, there was a much more of a retail flow into the equity markets. But it was mostly in the form of these passively managed or smart beta mutual funds. Now, what do we mean by that? ETF growth has resulted based on the explosion of the underlying indices that are being tracked. So if you want to start a fund that's an exchange traded fund and differentiate yourself from every other, say, S&P 500, there are ways to overlay essentially an index strategy. So it could be index plus, or it could be index minus. It could be subsectors of the S&P 500, say S&P 500 Financial Index. So as these ETFs have risen, the basis on which these ETFs could be created has also multiplied. It's gotten to be people be very, very creative. So as you can see here in this statistic, we're looking at the number of the stocks has actually fallen, while the number of indices, or these passive, quasi-passive, if you will, constructs in the market, have risen to the fact there are more indices now and have been created than there are actual stocks, which is an interesting phenomenon. And these tend to be either just passive or what we call smart beta. So smart beta is essentially a manager that's created an algorithm that follows the index very, very closely, but may vary on a couple of what the manager feels are common sense types of differences on the margin. So it replicates and correlates to the index, say 90 to 95% to call it the S&P 500, but they've taken out, for smart beta purposes, they've reduced weightings on, say, the lowest momentum or the worst performing stocks over the last 3 to 6 months. They just rotate that around on a process. That would be one potential form of smart beta. So, the way to think of this is that a lot of these indices that are being created are tweaks and modifications to the indices that you've probably heard of, like the Russell 1000 or the Russell 3000 or the S&P 500 or the ACWI ex-US Global Fund. U.S. mutual funds and ETFs, that have attracted over $1.4 trillion in new money, while it came out of funds charging, most of that growth, almost $1 trillion of it, came at the very expense of funds with more than 50 basis points of fees, which is a lot of funds out there. So the response to this has been essentially for active managers are going to have to cut their fees a little bit more, and they're going to have to find ways to become more tax efficient and create more stable, if you will, alpha, more stable positive changes. So that's what smart beta is all about, trying to tweak existing indices in ways that perform a little bit better on the margin. So taking a look at this active versus passive shift in net flow of funds over time, you can see that starting in 2010, there really wasn't much going into ETFs at the time, and the flow of funds was basically still to mutual funds, and that kind of zeroed out in over that following couple of years. And then starting in 13, this is essentially the difference in the fund flows into ETFs versus into mutual funds, and essentially ETF growth has come at the expense of, to the tune of nearly $500 billion a year now, at the expense of active, traditionally 40 Act managed funds. Active versus passive, it also has this thing that over time, this is essentially used generally speaking as a condemnation of active management and why passive funds, why ETFs are getting more and more popular, and it has to do with performance. So this chart is taken from S&P's SPIVA reports, that's Standard & Poor's Index versus Actives. So the percentages that you see here in the column for all of these S&P indices that they track, the S&P 500, the mid-cap 400, the small-cap 600, composite 1500. This is the number of managers that are losing to the index in the time period in the sector. So, for instance, in the large-cap S&P 500 traditional space, only about 44, 45%, 43% are beating the index on a one-year basis. But on a three-year basis, collectively, to beat it year after year after year, only 20% do that. And here's the 5-year number as well. If you look at the mid-cap, 7/8. In the small-cap world, 90% over 5 years fail to do it. And it's not necessarily the same 5%. That's just the number of managers that are able to do it over a 5-year rolling period. In any given 5-year period, it's smaller than that because if you're looking at the funds that beat it all 5 years, that's actually a smaller number. So a smaller number still, a subset of that's 6-7%. So active management, and it's the same across the board for whichever one of these funds you want to care to mention on a 3 to 5 year basis. It's typically only 10, maybe 20% of managers can beat the market on a rolling 3 to 5 year basis, which is why passive funds and smart beta funds, that is, funds that really track the indices very closely, whether intentionally varying or unintentionally varying a slight bit, they tend to perform better over time. But this number, what I would say as a caveat to that is this number that's active passive right here that I'm showing you, the 1 year number. A year ago, that was almost 2/3 of managers were losing on a 1 year basis. What changed in 2017? Well, what changes over time is that the correlation between the individual stocks and the index drops and rises. So for a good part of 2014, 2015, in these 3 to 5 year periods, the correlation between the individual stocks and the index was greater than 0.9 or greater than 90%. In 2017, that correlation dropped where it was more like 0.4, 0.45. So what that means is that stocks within the index collectively are moving in different directions as that correlation drops. And that gives a stock picker more opportunities to be different and then to excel from the overall index. When all the stocks in the index have a correlation of 0.9 or 0.95, they're all moving the same direction and in the same the same kind of variance, the same scale. So as they're doing that, whether you buy Apple or Netflix doesn't really matter because they're going to both move in a highly correlated fashion. So there's really not many opportunities when the correlation is high to beat the index. So this is one of the reasons why you're seeing, over time, even if the index correlations are dropping, overall in long periods of time, there's not enough difference between the stocks within the indices. make a big difference for managers. So I'll take a quick breath now, and we're going to kind of talk about something else, the new thing, which is Bitcoin and these other cryptocurrencies. The first thing that I want to point out about cryptocurrencies is that they are sort of currencies. That's why they call them cryptocurrencies. They're currencies, but they're not. And they're not, one of the things they aren't is they aren't backed by a specific government. The gentleman that created this, and we're not even sure who he really is, the name of the developer that's been released publicly could very well be, and is hinted to be, a pseudonym. But it's an interesting techno geek idea to create a so-called medium of exchange, or a currency that is not backed by a government, but that does seem to have value. So in order for a currency to be a real currency, it has to have at least these three things. And the first thing, it has to be a specifically defined unit. You have to be able to define what the currency is in terms of units. So dollars, plural; yen, plural; euros, plural. I mean, a euro has to be defined as a single unit, or a dollar has to be defined as a single unit. So a Bitcoin is a unit that is very specifically defined. It's based on a computer formula that looks for essentially prime numbers and assigns a prime number, a Bitcoin, within a specific computational limitation. So according to the formula created by this technology wizard, there are only 21 million Bitcoins that are discoverable, okay, in the computer universe that conform to this prime number calculation that he defined. So there will only be 20 million Bitcoins ever released. So in that case, Bitcoin would definitely qualify as a specific measurable unit that everybody can identify with. You can find quote unquote Bitcoins if you can run the mathematical calculation. Now the interesting thing is that as of today, here in early 2018, something like 18 million of the 21 million Bitcoins have been discovered or defined. Okay, there are still some computational calculations that can find another couple of 2-3 million Bitcoins that have yet to be defined. But the interesting thing is that the way this is distributed, it is a distributed computer, or what they call a blockchain. So the blockchain is nothing more than the computer record that is kept collectively by the computers that participate in the blockchain. And essentially there's an algorithm that everyone has to agree to that's participating in this market, that this number of Bitcoins have been found, this number of Bitcoins is assigned ownership to the following accounts. So blockchain, if that's how you're going to define a blockchain, the blockchain technology, I like to point out, people, is nothing new. If you've been buying stocks or bonds since the 1980s, you've been participating in a blockchain. It's called the DTC system, or Depository Trust Company. When your Schwab account or your Ameritrade account, when you have an account typically today that owns stocks or mutual funds, there are you don't have a certificate anymore. They used to issue stock certificates or bond certificates in paper. They don't do that anymore. They haven't really since the 1980s. The blockchain that is DTC is nothing more than a computer record that accounts for new issuance, that is, new stocks being issued or new bonds being issued, and then tracks the ownership of those issued securities or owned securities through all the trades of a given day. And at the end of the day, we call it a book entry system. It's book entry. It's an electronic system for tracking your stock or tracking your bond investments. So anybody that's had a TD Ameritrade has had the late Cretaceous period blockchain, which is DTC. I mean, and that's been around for 30 years. The notion of a computational winning, if you will, of a Bitcoin, or winning value by making a computation and collecting it, that's a little bit new. So the technology that exists to create this has been around for a while. In order for it to be a currency, it also has to be accepted by the general population for economic transactions. You've got to use it for purchases and sales of goods and services. That's essentially what money is for. It's what currencies are for. basically a transactional value because it has a certain value. It has a known value. That value can fluctuate, but it has to be a known value so that it can be traded for goods and services and must be generally accepted as a currency, accepted to have that value. So Bitcoins, are mainly used right now for cross-border transfers. That is, people trying to move their wealth out of places like Venezuela or China. It's also used most recently for speculation, as more and more people are opening accounts and speculating in the value, and for other dark web transactions, including illegal transactions, both across borders and within borders. So it's not generally accepted anywhere right now to purchase, for instance, food or clothing. It's not accepted at McDonald's or Starbucks for the most part. Although this is changing, you're not able to use your Bitcoins to buy the basics of life: food, clothing, shelter. People just typically don't accept them, although, again, this may be changing. But Bitcoin, under this definition of a currency, only qualifies sometimes as a currency. It also has to be thought of as a store of value. That is, you're holding Bitcoins as money in the bank to as part of your wealth, so that it can be reliably used for future transactions. Okay, so store of wealth is another potential use of currency. You store your wealth in the money. If you're a Russian oligarch in 1992, you probably chose to store your wealth in dollars or euro or at the time Deutschmarks or pound sterling as opposed to rubles, because you probably had very little trust in it. If you're an Iraqi businessman during the Gulf War or shortly after the Gulf War in the 1990s, you probably wanted to store your value again in European currency or yen or dollars, not in dinars. So people choose to store their value, store their wealth in these various currencies. And the simple question that I would throw out to the listeners here: does plus and minus 50% value change in a matter of days sound like good storage of your wealth? Most people would say, well, yeah, when it goes up, but things that go up 50% tend to go down 50%, and it has. So that's not really qualifying as a store of wealth, and only sometimes as a currency. So that's what Bitcoin is and what it does. And our own Chris LaMarca went back. I want to credit Chris for this. He went back to the dot-com bubble days and looked at the 269 trading days of the NASDAQ right before the market peak in March of 2000. So March 10th of 2000, and compared that to the recent Bitcoin high in December of last year, about a month ago. And the 269 trading days. And take a look at this. The NASDAQ and the dot-com bubble is a piker compared to the run-up in value of Bitcoin. So if this was a bubble here in the red, what is this? It's hard to say. Words would be hard to describe the kind of bubble that has become Bitcoin. Now, it could go higher. It could continue to have value. The blockchain technology does have uses. People store their wealth in gold, for instance, and gold does have industrial uses, but it's mostly valuable because people think it's valuable. If people continue to think that Bitcoin can be valuable, it will continue to hold, and blockchain will continue to hold value. But I'm not betting my personal wealth on it, and I don't think people should bet their personal wealth on it because it is so volatile. So the next thing that is a subject that we're going to talk about is the latest bull market kind of indices and where the buyers are coming from. Now, we've all known that corporate buybacks have been a big part of the demand and continue to be a big part of the demand for stock in the market, particularly post-financial crisis. What is surprising is that mutual funds and pension funds have been essentially shedding themselves of stock in the last couple of years. The biggest buyers have now been the ETFs. This shift, as we were talking about earlier, from mutual funds into ETFs. ETFs are the next biggest buyer, and then foreigners, non-U.S. Purchasers of stock, stepped up very large in 2017, being net sellers in the previous years, taking down $220 billion of new U.S. stock net over the last year, which to me is genuinely surprising. Individual investors, just retail investors, had been sellers of stock. They've been fairly neutral here in the last year, but that too is a reversal. So, talking about bond valuations and stock valuations, what's driving this market higher and higher? Well, the short answer is earnings. And what you're seeing here is these are the various analyst earning curves for the quarters going back to the first quarter of 2015. So we've got about a couple of 2-3 years of good data here that you can see. Essentially, this is courtesy of Jim Bianco and Bloomberg. He's compiled in this what I call the fishhook graph. So hats off to Jim for kind of quantifying for us this little game that analysts play. So, for instance, if you take a look at this first graph here, back in the first quarter of 2015, 2 quarters ahead of time, the analyst community was projecting a 10% growth in operating earnings for the S&P 500. As the quarter gets closer, okay, and we get into the third quarter and you're predicting next quarter's earnings, the earnings predictions just drop dramatically. So now, instead of projecting a 10%, the rosy scenario, if you will, by the time the quarter ends, they're expecting -6, and then lo and behold, it actually comes in as flat. So what this means is that there's this game that goes on where 2 or 3 quarters out, analysts collectively have their rose-colored glasses on, looking at tremendous growth in earnings, and the stock market's going to be fantastic because corporate profits have never looked better. And then slowly but surely they revise their estimates down, and you'll notice that each of these quarters kind of reaches its bottom point right as the quarter ends or shortly afterwards. See that? Each of these fishhooks bottoms out for the quarter as literally in the days of the quarter end. So that would be, in our case, January 1st through January 8th, say. And the same with all these previous quarters. And for the most part, in 15 and 16, earnings were trending downward. Starting in the first quarter of 16, 2 years ago now, earnings just started to shoot up. Okay, and this is the time since then. And whether it's at the point of the end of the quarter or the actual final number that comes in, all the numbers trended higher starting then. And it's no surprise then that the bottom of the recent market in corporate earnings, kind of the corporate earnings recession that we suffered in 14 to 15, February 11th of 2016. So right about here, as these low points in earnings were being realized, the market finally hit its bottom and started to turn around. So what this little game means is that in any given quarter, about 2/3 to about 70% of all S&P 500 companies beat their revised earnings expectations, but that's only because analysts are quickly knocking down their earnings estimates to a very low point right as the quarter ends, and then, lo and behold, they beat the revised expectations from the end of our quarter. So this earnings game is rather interesting to watch. What's interesting to me is that if you look at the current quarter, look at these numbers. Currently analysts are expecting just spectacular profit growth in the S&P 500, and they have been going back here for a number of quarters now, going back to 16 and 17. So earnings have basically been getting much, much better. That's why the profits, aside from the games that get played, real profits have grown. What's interesting about this particular quarter is that it looks like the expectations bottomed out back in November. That usually doesn't happen. Usually you get these earnings expectations. Okay. Yeah, a few more minutes. So, excuse me, we're just about done here. And Fred tells me I've been talking too much. So we'll end this by saying, look, these earnings expectations for this quarter are particularly robust. If you look at valuations, though, here's the S&P, and here's the Russell 2000 going back to the mid-90s. And you can see this is on a price to EBITDA basis, or earnings before interest, taxes, depreciation, and amortization. Why do we want to look at that instead of just earnings? Well, because overall earnings changed about 2000, 2002 because the accounting profession changed the rules. So anything before 2001 is apples to oranges if you look at earnings. But if you talk at earnings before depreciation and amortization, particularly goodwill, that's an apples to apples basis pre-2001, 2002. So the point is that these valuations on a price to EBITDA basis, that's the first reason. The second reason is we look at this because the private equity markets look at it that way. When people are looking at mergers and acquisitions, both public and private, or between public and private, or between public and public, they look at the price to EBITDA ratio as what they're going to pay. They're going to adjust this EBITDA, and this is kind of the mark that people use both publicly and privately. And those numbers are as high as they've ever been. On the bond side, this is spreads between risky bonds, the high yield index, and the treasury index, so the risk-free index. Obviously, risk was very high in 2008 and 9, but ever since 15 and 16, when the market recently had its corporate earnings recession, these risks have been coming down. So we are at one of the near all-time lows, this very, very complacent era. These are eras of complacency, 03 to 07, 96 to 98, irrational exuberance, as the maestro Alan Greenspan called it. This period here after the sigh of relief after the global financial crisis and the Greek debt crisis, these are periods of extreme complacency, and that's where we are again today. Real quick, from the Federal Reserve of St. Louis, we're finishing up here with GDP. You've seen the velocity of money continue to come down over time. This velocity of money is how fast cash turns over in the economy. But the consumer price index has been on the floor now for most of the period after the global financial crisis, and 3-month T-bills as well. But now we're tightening money a little bit. As you can see, T-bills going up as the Fed's raised rates a few times. Here again is a similar graph where you're dropping off this velocity number on the left-hand graph, but the S&P continues to go up. And as again our analyst Chris LaMarca points out, in periods past, these two seem to correlate. Money moved faster as the stock market got better and the economy produced. When the money velocity slowed down, the economy slowed down, and the markets started to fall. Same happened again in this 07-08 period. The velocity of money drops, the markets fall. Velocity of money has continued to drop in the quantitative easing era, but the markets have just skyrocketed. The conclusion is that the money is not going into the real economy that's been printed, it's going into the markets. So in summary, I'm borrowing some lyrics from a song by the rock band Styx in their album that they released in 1979. There's a song called Borrowed Time. And the chorus went, living high, living fine, living high on borrowed time. So we kind of see this, all this monetary stimulus as it's being unwound, as living on borrowed time. These markets have been Goldilocks markets. It's when good news is good news, no news is good news, and bad news is still pretty good news. So we've been pushing things up mostly on earnings, and we've been pushing levels and valuations up mostly on borrowed money and quantitative easing money. As we withdraw that money, it'll be very interesting to see how much borrowed time we have. So with that, I am going to be quiet and throw it back to Beth and see if we have any questions here.
Scott, great summary there. No, at this time we do not have any questions popping up, and we are right at our ending time at 11:45. Everyone will receive a follow-up email tomorrow, and it will have contact information should you have some questions and want to reach out to Scott or myself on this topic. So we appreciate everyone's time. Thank you, Scott, and your team for putting this great presentation together, and appreciate everyone's time today. Thank you so much.
All right. Thank you. Bye-bye.